Great, thanks, Cynthia. I want to thank everybody again for joining us today. I think we've got a very exciting webinar for everyone. We're very excited to work with O'Share Investments in the new ETFs that they've come out with and that are now on our platform. And we'll be hearing from Connor O'Brien, who is the CEO of O'Shares. And I think you all know ABC Shark Tank investor and CNBC contributor Kevin O'Leary, who's chairman, and who together they co-founded the O'Leary Funds, an investment fund focused on income, capital appreciation, wealth preservation, that has grown to approximately $900 million in assets under management. Recently, O'Shares ETFs were launched in 2015, and the belief at O'Shares is that when making an investment choice, it should be very easy to understand where your hard-earned income or investment capital is going, where are the benefits, and what are the potential risks. The core investment principles are centered around three basic philosophies: income, wealth preservation, and capital appreciation. And O'Share exchange-traded funds are now up on our platform. So we're very excited to hear from both Kevin O'Leary and from Connor O'Brien, and I'm going to turn it over to Kevin at this point. Kevin?
Thank you very much, Bill. I want to talk about the genesis of O'Shares. I'm actually an investor trying to solve for my family trust. That's why these were created. And I'll explain the genesis. So after I sold the learning company to Mattel in '97, I founded, as the rest of the founders did, a family trust. Mine was a very simple mandate, but I think today you'll understand my challenge. What I did was create a trust that was 50% fixed income and 50% equities, but it was designed to take care of children from the age of their first day of birth to the last day of college, and then cut them off, and then take care of their children from exactly the same metric, their issue from date of birth to last day of college. And the reason I decided to do that was that's what my mother did to me. So it worked for me. It's hopefully going to work for them and the generations ahead. The mandate, as you know, with a 99-year trust, this particular trust rebalances every January 31st. So if equities had a great year, it rebalances back to 50-50, et cetera. But the challenge is I have to pay out 5% a year, every year, year in, year out. Back in '97, no problem. If you want 5%, you just buy a ladder of govies, and you would take from that side of the fixed income. All of you on this call, if you're involved as financial advisors or investors, know how challenging it is today to actually make 5% year in, year out, particularly on the fixed income side. So I need the equity portion to take up some of that bogey. And what I did in just sort of researching the markets over the years and trying all the different mandates you would in a family trust, private equity, hedge, long, short, all kinds of different asset classes, all kinds of different managers, what I realized, what really plagued me, and it generally happened every 5 to 7 years, was material style drift. Because really, this mandate is so long-term that it's all about preservation of capital. I don't need more money in it. I just need it to generate 5% year in, year out without grind. In other words, not returning principal. So I decided on the fixed income side to start looking at a new asset class. You know, ETFs are not that new, but back in '97 they were just emerging. And I started looking at them then, really didn't do anything about until 2 years ago. When I started to say, wait a second, maybe there's a way to find ETFs that just pay dividends, because I want dividend payers. I'd like to make at least the industry return, which is around 2.3, 2.5% on the S&P. That's kind of half my bogey on that 5%, so that would be great. The problem was that if you look at all of the 49 to 50 of the ETFs out there, and there's some great ones, because I had Connor, my partner, do some research for me, because he's very much in how he designed this solution. All we found were first-generation ETFs that are market cap weighted, so that you would end up in a situation where, yes, you had dividend-paying stocks, but 4 or 5 names were practically 50% of the index. And so that breaches my #1 mandate of diversification. In my trust, we never own more than 5% in any one name, never more than 20% in any one sector. So we decided to try something a little different at the time, and this process started almost 2 years ago. I said to Connor, why don't we approach an indexer and explain my problem and see if they would consider designing an index just for me. And, you know, obviously indexers don't do that very often, but I felt that if I could solve this problem for my family trust, wouldn't there be others in the market, if I could communicate it, that have the same issue, that are looking for really long-term? And here are the attributes I wanted. Obviously, preservation of capital. because I have that 5% bogey, I wanted 50% more yield than the S&P. So instead of making 2.5, I want 3.5. I also wanted to have 20% less volatility in the market, because one of the benefits of dividend-growing stocks is they tend to have less vol, particularly when you look at this month, what a wild ride it's been so far. But also, I wanted to somehow test the balance sheets of all of these companies that are held in the indices, because I really want to make sure that they're not using tricks like leverage to increase dividends. You don't want to do that. I don't want accrued revenues from the WorldCom days. That's useless. I want cash flow that's growing from operations, so these companies have the potential to grow div, and that really matters. So quality metrics on how they're turning over their assets, and test these companies on an ongoing basis so there's no style drift. So in a synopsis, 20% less volatility. It has to pay a dividend. It has to have a quality balance sheet, and obviously pay out in an aggregate, and this is just one of the results of putting rules like this, a strong dividend so that half of my 5% bogey or better is paid out. That was the genesis of this new index that became O shares, and the first product was that of OUSA. Now, if you look at this next slide, really the synopsis here is about wealth preservation. That's what really matters. But, you know, if you think about investing long-term, it's not just stateside S&P companies that are enjoying dividend growth. It's global these days. Obviously, economies like the Asian economy, even though it's gone through a lot of volatility, still enjoys significantly higher GDP growth. And Europe is looking really attractive these days because they've got a much more competitive currency, and they've got massive companies across all sectors. And I want diversification across all sectors, but not just stateside. I want it global. So we took the same index that we created for OUSA and said, if it's good for the United States, why isn't it good for Europe, and why wouldn't it be good for Asian markets too? I want to own dividend payers. I want quality. I want low volatility. I want large market cap. Give me the same indices in all the large cap jurisdictions so I can actually have investment across multiple geographies, which is part of the trust mandate. But here's the key to realize. If you look at any market, look at just the U.S. over the last 20 years, and you'll see that what you've got is the majority of returns, or almost 42% of the last 20 years, came from dividends. And so in the indice itself in the United States, that's one of the reasons that we've made sure that it's only dividend-paying stocks, in addition to the low volatility it provides. But also it's the same story in Europe. 59% of total returns over the last 20 years came from dividends, not capital appreciation. So for the indices in Europe and OEUR, the product there, we also created an index that taps into this fact. So dividend payers in Europe, it's a good solution for that too. And why would you even consider Europe? So many investors don't want to leave domestic mandates. Well, here's why. Last year, for example, we were basically flat stateside. Europe posted a 10.3%, and Europe or Asia, Japanese market, for example, was 12%. In fact, if you really look at a heat map of what's going on in countries, you want diversification across all of these countries. And the way I'm doing it in our trust on the equity side is I'm using these tools we've created at OShares to do a series of things. I want to hold 50% of the dividend-paying index in the United States at all times. I want 25% in Europe, and I want 25% in Asia. So I've got a basket of names across all jurisdictions, all dripping cash like a chicken on a spit. That's the way I look at it, and paying out 5%. And now I've got the equity side doing half the work so that I don't have to push and extend duration and take risk on the fixed income side. But my fiduciary said to me in the trust, listen, we want to have some control over currency. We want tools that allow us to dial in a hedge if we wish. And, you know, you can have an opinion about whether you think the USD is too strong or it's going to go further or whatever. The way we're holding it in the trust is we've put on hedges for 30% of the European currencies and 30% of the Asian. And the way we've done that is to create hedged versions of Europe and Asia. So ASI, for example, is unhedged Asia, but OAPH is hedged. So I own 30% of the 25 in Asia hedged and the rest 70% unhedged. So really O-Shares today is a series of 5 tools that gives any advisor complete geographic diversification, sectoral diversification, and a tremendous diversification in terms of the actual market cap weighting, because these are rule-based ETFs. You don't get stuck with Apple being 16% of your OUSA. It can't get there because every quarter we check against the weighting and trim it when it gets over 5%. And so that's perfect for me. And it may not be good for everybody, but this really fits the mandate on an ongoing basis because it gives me the diversification of the rules of the 97 mandate. And here's a little performance of market cycles, that should encourage you to explore buying Europe and Asia, even though many people don't look at these markets. In any given year, and we've got data here from 1999 all the way through to 2015 last year, you're never assured that our domestic market is going to outperform. In many years, it simply doesn't, and last year was a good example of that. And just think intuitively about it. If you're a company manufacturing a good or service in Europe and you've got a currency that's depreciated 20, 30%, you've got a wicked competitive advantage. And, of course, I would like to own some of that dividend yield and growth in those European countries across multiple sectors. Great biotech, automotive, energy, you name it, they're available in Europe as well as a competitive advantage of currency. So that does matter. I'm just going to move the slide forward here. Same thing if you look at U.S. and Europe on a hedge basis. Whether you hedge or you don't hedge, you get tremendous diversification in terms of where performance comes from. So I encourage people to think in terms of getting some exposure to Europe and Asia in any mandate that's long-term. And I've told you the way I'm doing it. I'm not suggesting you follow the same, but it's just one trust doing one thing. 50% USA, 25% Europe, 25% Asia, and the Asian and European portfolios, which are multiple currencies, are hedged 30% USD. My personal opinion is that these companies you're looking at here represent the very best investment opportunities in every jurisdiction for conservative investors that want low vol and high yield. And these mandates in Europe and Asia are yielding significantly more cash yield, closer to 4%. So I think in terms of getting to my 5% bogey, they're a very important part of the portfolio. Many of these are names you've heard of, LVMH in Europe, Roche, Siemens, Nestle. They're terrific holdings, and they have a huge advantage right now with the currency. Toyota, West Farmers, Nicomo, NTT Group, great Asian holdings, large cap, good dividend payers. I'm going to hand it over to Connor O'Brien, who had so much to do in designing these indices with FTSE Russell, has done a masterful job. And you only have to look at, even though OUSA is a youngin in terms of ETFs, just look at the performance it's had since the end of July in these brutally volatile markets. It's done exactly what it was designed to do: preserve capital, give a material outperformance, be significantly less volatile, and pay materially more yield. Connor?
Thank you, Kevin. Thanks, everyone, for joining us for today's web event. And I'd like to thank Interactive Brokers for inviting us to do this as well. Interactive Brokers has a really terrific platform, and we're very pleased to be commission-free on that platform. So I encourage people to take advantage of that. I'm going to just tell people a little bit about what Kevin asked me and the team to do, the challenge and the objectives that he had for his family trust. He gave you his summary. When I looked at it, it was basically a challenge of developing an index-based strategy that would generate more yield, 1.5 times the yield of a generic market cap index, take less risk, about 20% less risk, and that measured a couple of ways. Volatility is one way, the other in terms of drawdown. So minimize the drawdown to be at least 20% less than a generic market cap index would decline in a down market. And finally, generate excellent performance with those first two constraints described. Kevin also has a rule regarding diversification. Can't emphasize enough the benefit of diversification, as all of us probably remember from Finance 101. It really is the only free lunch in investing. And what that means is get diversified in each of these strategies, diversified across all of the major industry groups, the industry sectors. What you see in so many ETFs that have decided to try to pursue dividends or low vol is a strategy that's very much concentrated in a couple of industry sectors, and that results in less diversification and more risk of certain sorts that people may not really want. So what we did was, with our team, after the research, interviewed a number of different index development partners. We selected FTSE Russell. Everybody knows both FTSE and Russell, now all one firm, has over 2 decades of experience in developing index strategies. And they were fantastic to work with. What we developed with them is a strategy that reflects our experience as investment managers and investors and their experience as index strategy developers. Can you just go through the summary or description of the methodology that was developed? Just before I do, I'm just going to highlight the industry sector diversification. You see it here across all of the OUSA fund and all the sectors in the U.S. You see it for OEurope and OEurope hedged, sector diversification again, and in Asia, once again, very good sector diversification. It's extremely important. This page shows you a highlight of some of the key names. These are motherhood and apple pie type of names, big dividend-paying, dividend-growing companies, and in a portfolio is extremely diversified. When you actually get time off this call, after this call, to take a look at these funds, take a look at OUSA, compare it to any of the ETFs that you use or you're familiar with. And I think you might find that the performance has been exceptionally interesting, and the volatility reduction has been an additional benefit. So this methodology, it really combines 3 very important factors. I think the first one is most important, and I'm going to spend the most time on. I think a lot of people understand what volatility is, understand what yield is, and the way that we measure volatility and measure yield, I'll just touch on. Quality sounds like it's qualitative. It's not necessarily a discipline. It's somebody's opinion. Well, when boiled down to financial metrics, one can actually screen out and score companies based on quality. Think leverage. Less leverage is generally better than more leverage when it comes to quality, when it comes to risk. Think of asset turnover and return on assets. You want higher profitability, higher return on assets. You want stronger asset turnover. And finally, on earnings, you want your earnings to be real earnings as opposed to revenue that has been booked but not yet received in cash. As Kevin's referenced, Enron, WorldCom, other companies of that sort that book revenues before they actually get paid cash. So FTSE Russell does is use all their historical data on all of the companies in the investable universe, screen them and score them for these metrics on quality, another set of scores for volatility, basically using standard deviation of the last 5 years of weekly returns, and then yield. Not just scoring on straight yield, where a yield that's 4 scores twice as high as a yield that's 2%. That would overweight the higher yielding companies. What they do is they use the logarithm. We probably all now remember logarithms from high school. It basically desensitizes the methodology to yield, so you don't end up reaching for high yielding stocks just because they have yield. So that when you blend these 3 factors together, quality, volatility, yield, gives you a high quality portfolio with lower risk and with strong yield. And then ultimately when it comes to performance, you'll see when you look at it, gives you performance I think you'll find extremely interesting. We'll look at the portfolio results here. This is the portfolio of OUSA compared to passive indexing. So passive indexing is basically market cap weighted index. And you can see here an ROA of 7.9%. Using the quality metrics in our portfolio and the index behind our portfolio, get increased ROA to 9.4. Leverage decreased from 4.7 to 3.6. Volatility decreased from almost 25 to 21. So in every case, achieving the objectives of the O'Leary Family Trust. Better quality, more ROA, less leverage, less risk. let's take a look at what it gives us in terms of sector diversification. The dark bars show you the weighting of the index and, of course, of the fund. So more allocation to consumer staples, comparable to healthcare. You go through the rest of the sectors. We're in every single sector, extremely important. When you look at energy, it's the very high quality, dividend paying, low leverage energy companies. And with oil at $30, perhaps it's time to make sure you have a little bit of energy in a portfolio. For Europe, what result did we get here when we applied the exact same quality, volatility, yield factors? ROA increased from 6.1 to 7. Leverage decreased from 8.5 to 3.5. That's a very significant decrease in leverage. Volatility decreased from almost 28 to 25. So again, achieving the family trust objectives, quality, ROA, less leverage, less risk. Just want to point out something about leverage. I think everybody knows this, but in a rising rate environment, leverage is probably a more painful characteristic to have in a company's financial metrics than in a low rate environment with no pressure on interest rates. When you have refinancing risk and refinancing costs, you probably want to have a portfolio of companies that have less leverage. So this is one of the examples regarding why quality at a time like this in the market is particularly attractive. And I'll add one more point to it. If you look at any research, you can find it on the web, you can find it in many places. Research regarding quality shows that quality stocks tend to have an even greater advantage in the later stages of a bull market or cycle. And again, it's because growth is slowing, it's because interest rates are increasing, and those sorts of characteristics. Let's take a look at the sector distribution that we get in Europe. Again, full sector diversification. And now if we move ahead to Asia, we see here again ROA much increased, leverage much reduced, volatility much reduced. Again, family trust objectives achieved. Take a look at the sectors, full sector diversification. Quick snapshot of people's smiling faces. Here are some of the key members of our team, myself, Kevin Beetlesteyer, and Tappan, and we're continuing to add to the team so we can provide people the very best investment service. I'm just going to flip through a few slides here before we get to some Q&A. This is just showing some fourth quarter performance metrics. See since inception and year to date. If you actually look at the metrics that you can find on Bloomberg or on whichever service, on Interactive Brokers probably, and some of the other services, you'll be able to get the comparison in the way that you'd like to see it. But in every case, we're very, very happy with the performance of these funds. Before we go to Q&A, I'll just reiterate one of the things that Kevin mentioned, which is diversification. And for his family trust, they diversify across the U.S., Europe, and Asia. If you recall those heat maps, you go back and you look at this after the call, you'll find that the U.S. is the best performing market compared to Europe and Asia. It's the best performing market about 50% of the time. And that holds true whether you look at currency hedged or natural currency of the underlying portfolios. About 50% of the time, U.S. performs better than Europe, better than Asia. What that means is Europe and Asia are performing better 50% of the time, and it might cause you to want to actually have a little bit of exposure, maybe as much or maybe different than Kevin has for the family trust, where he's 50% U.S., 25% Europe, 25% Asia. We give you these 5 tools. They're built using the same investment philosophy, the same investment index methodology, and the same process across each one of these portfolio building blocks. So I'd like to turn things now back to the moderator. Perhaps we have some questions. If we don't, I have a couple of questions I'm going to challenge Kevin with. And I think for people who are wondering where you would put in your questions, there's a chat box on the lower right of your screen. And you can type in your questions in the very bottom section of that chat box. So Kevin, here we are 1 month, roughly almost 1 month into 2016. It's been a pretty rough month. Tell us a little bit about how the family trust portfolio or your portfolio has fared, and tell us what you're thinking of or positioning for the balance of the year.
Well, our end of January rebalancing is coming up, and we started to layer in to purchasing OUSA and the unhedged versions of both Europe and Asia. Those have been, obviously we're buying those at 50% for OUSA, 25% and 25%. We haven't really done much yet in Europe and Asia because of the volatility. We're all waiting for the currency, but OUSA we've been very active in. And it's been doing exactly what it was supposed to do from July. And I think it's been interesting to see what's happened with this story because it turns out that there's a lot of interest in low vol as a result of even the beginning of January. I was recently on Jim Cramer's show, Mad Money, and Jim had looked at the performance of it. There's more and more interest occurring in ETFs, particularly for people that want to find diversification strategies. And last week he called out and basically said some pretty nice things about it. But basically his guys had done their research on it and looked at it against all the other ETF dividend payers. And there's a lot of interest today, and I think this is why people are looking at O-shares, in moving ahead with new generations of ETFs that solve for concentration issues that the first generation found themselves stuck with. So you create an index and it's market cap weighted. It just happens that you're going to own 4 or 5 names that end up being close to 50% of your holdings. That doesn't happen in the new generation of rule-based products. Some people call them smart beta. In fact, there's a conference here in Florida next week that is probably going to be the biggest ever around this new generation of rule-based products, and OUSA is right in the heartbeat of that. And it's what I like to say about ETFs, and which is why I'm pretty happy about what Connor's done with the guys at FTSE Russell, is in the end, it's about performance. That's all that matters, and it's been doing a phenomenal job. And those of you that are interested, I think, should just compare it against pretty well anything, the index and many of the other ETFs, and you'll be pretty happy with what you see.
We have a question regarding fees. I'll just answer that one. Fees for OUSA are 0.48, so 48 basis points. For Europe and Asia, it's 58 basis points, and for the hedged Europe and hedged Asia, 68 basis points. And I'll go back to a question for you, Kevin. We've got the 3 major regions here. It's early in the year. Where do you want to have your money for this year? Asia, Europe, USA? Which market has the headwind? Which market has the tailwind? Think of catalysts, think of valuations.
My theory is that we haven't been paid the low energy dividend yet here stateside, and that we'll be pleasantly surprised with earnings in the back end of the year, Q3, Q4. You know, there's a lot of anticipation of where we would get this upside in consumer or even in chemical or industrial processes that enjoy this in remarkably low input cost of energy being, you know, at generational lows. And so I'm optimistic that we'll do well, even though there's some headwinds regarding currency. But for domestic companies that have input costs of energy and consumers who are spending a lot less gassing up, I'm optimistic for around 5% earnings growth in the S&P. So, you know, it's a market I know, and it's a mandate that we've got, so we'll be 50% there. But I think the one that's going to outperform again is Europe, because massive market cap companies with an incredibly low euro, they're just going to continue to sell both into the new emerging market of middle class in Asia, and of course here in the U.S. they have a competitive advantage. And if the Fed, and we don't know this, if the Fed does another 25 bips, it just exacerbates exactly that problem. Europe has a huge advantage. They're not raising rates. The Canadians aren't raising rates, that's for sure. And we are stateside. This dollar's on fire. And so you've got to have some diversification. I like Europe and I like Asia for that reason, currency.
Yeah, and Europe is a couple of multiple points cheaper than the U.S., as well as having a currency that's now some 30% cheaper than it was 12, 18 months ago. So their earnings should get a boost from that. Do you have any comments on energy? Here we are at $30 oil, maybe trying to find a bottom. what do you think about when it comes to the price of energy and the global politics of energy?
You know, there's a very weird link in this down cycle. This is probably, I think, my 5th down cycle on commodities. But you've got large cap, unrelated stocks trading in sync with oil prices, which makes no sense whatsoever. And so when we have a really bad day on oil, another 5% down, it pulls down all the other 9 sectors of the S&P. And so I don't know when that correlation ends, but it doesn't even make sense. If you could ask yourself this, if I could invest in an economy that has 0 energy input costs, would I prefer that, or would I prefer paying $120 a barrel for oil and feeling bullish about the rest of the 9 sectors? And obviously, you know, one of the big opportunities of the domestic market, in the European market, frankly the Asian market, is when that decouples and the other 9 sectors get set free. And yes, it's bad for energy and it's going to be horrific and all that, but we have completely discounted the value onto the other 9 sectors. And so even though it feels weird to invest in down days that are driven by a decline in the price of oil, this too will pass. I'm extremely bullish for what's going to happen outside of energy. Not so bullish for energy. You know, I just think it's going to be a price war. This is like a Kmart price war with global participants, and I don't think it's going to end anytime soon.
We got the question back to sort of more technical regarding the fund. I'll just cover some of these. So one question regarding how frequently we adjust the portfolio. The portfolios are adjusted quarterly to implement the 5% cap on any one position to make sure no position or any position that's grown above 5% is reduced to 5%. And there's a full portfolio index reconstitution and portfolio rebalancing on an annual basis. The result of that is it's a relatively low turnover portfolio, with the exception of that quarterly application of the 5% cap that will affect a few stocks at that quarterly rebalance. Far more adjustment done on the annual rebalancing. Another question is regarding sector allocation limits. And there are limits, so sectors cannot be massively overweight or underweight. The limits are tied to or based on the generic market cap composition, plus or minus 20%. So let's say there's a sector that's a 10% weight, multiplied by 1.2 or 0.8 to get step 1 of the upper and lower limit. And then there's an additional fact that allows it to be a few hundred basis points above or below the multiplier range. So a 10% sector could easily be at 15 or at 5, but they wouldn't be at 20 or at 0. So that's applied in a way that keeps us invested in all sectors, and it also keeps us from getting too invested in any one sector. So as you're hopefully hearing from our comments here, keeping risk down is a very important characteristic of the investment methodology and of the index methodology. And focusing on the quality to get the benefits of that factor, also, of course, a fundamental building block of the methodology. Kevin, I have another question that I'll ask you. If it's more technical, I'll take it back to myself. Regarding the tax implications investing in ETFs, they're, of course, have a great reputation for being extremely tax-effective investment vehicles. How much has that played into your shift in thinking to using ETFs more and more going forward?
It does affect our thinking at the trust and my own personal investing as well. But what's most attractive to me and to us is no style drift, that we can use these tools for extremely long periods of time. In fact, I anticipate that we will quite shortly not have any individual names anymore. Just we've got over 500 names across all 5 of the tools within these indices, and I don't see a reason to let anybody try and get emotional about a name when I can have it done by rules that have absolutely no emotion associated with them. I was very pleased to watch OUSA kick out Apple when one of the leverage rules were tripped in early September and add weighting to Microsoft. And, you know, obviously if you were a manager, you would have loved that outcome and boasted about your skills and about your foresight. But the fact is the rules that were created for these indices did that on their own, saved a lot of downside in Apple, and bought a better balance sheet in some ways. Although people seem to think Apple's got the best balance sheet, the margins are getting compressed, and there's a lot of concern about sales momentum. And somehow, you know, the internal asset turnovers and margin tests, OUSA did what it was supposed to. So I'm even more comfortable just knowing no style drift, diversification, sectoral diversification, and now geographic. I never really get driven by tax. It's nice to have it, but when you're investing for past a lifetime, it's kind of irrelevant. I'm kind of hopeful in the years ahead we'll have lower taxes. I don't know that, but I think these tools are good for anybody that has a long-term view or a long-term mandate like we have in the O'Leary Trust.
Great, thanks. Question regarding the portfolios again, so just to provide some of the data. And this is data that's available on the website, oshares.com. Actually, on the website, you'll also be able to get easy access to the replay of O'Leary with Kramer on Mad Money. It's short, 5, 6 minutes, 7 minutes, really entertaining. Anyhow, on OUSA, 144 stocks, portfolio yield is over 3.3%. In Europe, about the same number of stocks, a portfolio yield of 4.5%. And in Asia, actually, a portfolio that's slightly more stocks, 257, and a portfolio yield of a little over 3.6%. Also on market caps, the weighted average market cap in each of these portfolios is in the 25 billion, 35 billion plus level, so they're all very, very large companies. And that goes back to that safety characteristic. Comes out of the starting universe, but then also comes out of the result of the quality volatility yield multi-factor methodology. I think at this stage, before Kevin has maybe a final closing comment, I'd just like to remind people they can get more information at oshares.com, and they can also get information through our sales team. Use info at oshares.com if you'd like to invite someone to contact you. We really appreciate your time spent with us today. We really appreciate Interactive Brokers having us on their platform and commission-free. We think Interactive Brokers is a fantastic platform and really an innovator in the industry, and we're very, very pleased to be partners with them. Kevin O'Leary, I'll give you just a minute to give the audience a closing comment or two.
Well, thanks, Connor, and thanks to Interactive Brokers. It's great to do this. It's a very effective way of communicating at least what we're trying to do with these indices. I would also invite anybody who's interested to come to the ETF conference in Hollywood, Florida next week. It starts on Sunday, Monday, Tuesday, and Wednesday. It's such an important event for the ETF industry globally that the CNBC truck will be there. Bob Pisani and other shows will be broadcasting directly from the floor. I'll be participating. There's a tremendous amount of excitement about rule-based smart beta product. It's a category that's growing, very, very efficient for investors. And it's because there's so much interest in it, the press is responding accordingly. And it's not often that, you know, national broadcasters commit to one or another conference, but this one is the granddaddy of them all. And so if you're not planning to attend, you'll get a lot of information by just tuning into CNBC, and I'll see you there. Thank you for your time today.
Thanks, Kevin and Connor. I really appreciate this. I think it was a great webinar, very interesting approach to the investment philosophies of all of these funds. And I would like to stress again to everyone that you can now trade these ETFs, all of them, on our platform, commission-free. You can get more information through your Interactive Brokers account. As Connor told you, you can also go to their website and have someone contact you directly from their firm if you'd like to learn more. And we've provided information on our site so that you can also contact them or read more about them. So again, thanks very much, gentlemen. Very much appreciate the time that was put into this today. And thanks for all those that were on this webinar with us.
Now, for those Interactive Broker clients who would like to get access to the commission-free trading and more information about the O-Share ETFs, I'm going to quickly share my screen with you, and we'll go out to the Interactive Broker website where you can locate underneath the pricing menu. Notice if you go to the commissions page, we start you off at stocks, ETFs, and warrants. But the key is to either check what type of commission structure you're under. Whether it's fixed or tiered, you can find the information in North America, and then notice that as we're taking you to the U.S., you'll find a link to the O-Share ETFs that are available. Accessing that, notice here how I'm going to pull that information up, and we'll go into the specifics here. Notice commission-free trading. But also, I do want to point out, and I just put into your chat panel, there's a separate page here. You'll see a link is included in the webinar notes. Notice this will take you out to the O-Share ETFs. As I scroll down on this page, you can find more about that commission-free trading that's available. And then notice that here are those ticker symbols. Someone asked me, what tickers would you use to access the O-Shares? Well, just as you were seeing in the slides, you'll notice here, each of those selections are available with the prospectus that you can download. And for someone who was looking, saw that someone was looking for the management fees. Notice if you go right into the fact sheet here, you can find each of those laid out for each of the separate funds or ETFs that have been made available. So with that, I want to quickly thank my colleague Bill McGowan for making today's event possible, as well as Kevin O'Leary and Connor O'Brien with O-Shares Investment. Let me take you back over into our main event window where you can all, one more piece, everyone. I do have one piece of business to do, and that's a poll. So notice I've just opened up a polling panel on your screen, and I ask that you take just a quick moment and answer those 3 short questions, 2 or multiple choice, so we try and keep this rather quick. By the way, number 2 has an input field, so if you have any suggestions for other topics you'd like to see on these webinars, that makes a great place to put it. Poll is only open for about 5 more seconds, so please make your selection there, and then simply click the submit button. Thanks, everyone. Poll did end, so I do appreciate that feedback. It is extremely helpful. So with that, we are going to conclude our event today. I want to thank all of you for your participation here and remind you that we've been recording today's presentation. Both the recording and the webinar notes will be sent to you shortly as soon as I get the recording compiled and uploaded to our servers. You'll get a direct link to today's recorded playback. And as you exit today's session, if you'd like a copy of those slides, simply watch for the drop-off link that will appear once you do exit the session. So thanks, everyone. Have a great afternoon all. And remember, everybody trade smart. Have a good one. Thank you.
So